In this market update, I'm going to show a comparison of the stock market today versus when Obama got into the office, as well as our concerns about high yield bonds. Hi, Jim Gore from THOR Wealth Management. The stock market is excited with the Trump win, but is it going to last? What's very important is that you never make investment decisions based on an election. We saw that happen before, and it didn't work out well for some of those people that did it. And I'll get to that in a few minutes. The indicators that we like to look at is looking at the valuation. The THORdex right now is at 76. And when it's between 60 and 80, the average rate of return on the S&P 500 over the next 10 years is only 5.79%. So what it's saying is expect lower average rate of return over the next 10 years. It's not going to give you the 10 to 11% rate of return that you're expected. We've had a couple good decades here of good stock performance, so expect less returns. The market is expensive. But just don't believe our indicator. I have two other indicators to show you. First is the Shiller cyclically adjusted PE ratio. Now this is known as the CAPE. And this is over a century and a half looking at the valuation of the stock market. The average over that time period is 17 times earnings. If you look at the CAPE right now, it's at 35 times earnings. Only two other times was it more expensive. And the bigger one that was bigger was right in 1999. The market was a lot more expensive. Another indicator, and this is probably why you're seeing Berkshire raise a lot of cash, is the Warren Buffett indicator. And this is looking at the valuation of the overall stock market divided by GDP. And it's 2 times it right now. And when you're looking at that, the valuation has only been 1 time more expensive, and that was right before COVID. Now, go back to 1999. It was expensive, but this indicator wasn't as bad as a cyclically adjusted indicator, but it's showing it is at an extreme. So I mentioned earlier, you don't want to make investments based on an election. Last time we saw people do this was back when Obama was elected. We saw people want to get out of the stock market, and people were putting money in emerging markets and gold at the worst time, or holding cash, which is a bad thing to do because the market took off after his inauguration for the next 4 years. It was a very good stock market. So let's look at the indicators of where Obama was back then and where it is today. So you look at the THORdex. The THORdex was at 9. The THORdex is at 76, so it's 8.4 times higher than what it was back then. When it was 9, our indicator, our THORdex, was saying back up the truck, overweight your portfolio in equities, and that's what we did back then. Look at the Shiller PE ratio. It was 15 times. It's now 35 times, so it's 2.3 times higher than what it was back when Obama was elected. The Buffett indicator was at 0.64. The average is 0.88, so it was below the average. It's 2.03, so this is 3.2 times higher. Well, another indicator is saying, hey, if I'm an investor, especially someone that's looking to live in retirement and live off my income, what are those indicators showing us? So look at the S&P 500 yield during the day that Obama was inaugurated was 3.4%. The 10-year Treasury was 2.9%. So why on earth would you invest in bonds back then when you were getting a higher yield on stocks with the possibility of growth? It was a great time to invest in stocks, and that's why we overweighted portfolios back then. However, look at where we are today. Today, you're getting a yield of only 1.2%. So you're getting a 65% haircut, less in income on buying stocks than you were back when Obama was elected. So you're getting significantly less income on your investments. The other thing is, look at where the yield is on treasuries, 4.4%. You're getting 51% higher yield. So it's complete opposite of where we were, where we are today than where we were when Obama was elected. Market was cheap, and this is why fundamentals matter. You don't want to invest based on an election. You have to look at the fundamentals. There's one other asset class that I think you should be looking at, and looking at the difference as well, is high yield bonds. And this is looking at the prime rate compared to the double B, which is your higher quality junk bonds, if you will. And whenever the prime rate is above what the high yield bond market is yielding, That's not a good time to be investing in high yield. And you can see that. There's been several times that has occurred. Back in 1999, high yield, the yield that went up, which means you lost money on those bonds. We saw it back in 2007. There was a gap there that the prime rate was higher than the high yield. And what happened was high yield yields went up. Same thing in COVID. You saw the gap. Now look at the gap. It's the highest it's ever been, the longest it's ever been. So you have to be very careful about putting money in high yield and especially in private credit. If you have any questions or concerns, as always, reach out to us here at THORwealthmanagement.com or give us a call. And have a great Thanksgiving, and I'll be back mid-December. Take care and talk to you soon.